What's going on, guys? Welcome back to Broke Man Finance. Back in August, Rocket Companies, or what most people refer to as Rocket Mortgage, IPO'd and made themselves available to us as investors. And since they just posted their third quarter earnings report, they definitely had a successful launch. So Rocket Companies, or their ticker symbol RKT, is the parent company or the overhead company of several well-known mortgage providers in the United States, such as Quicken Loans and Rocket Mortgage. In addition to that, they also have several other smaller mortgage and auto loan financial providers that is labeled under them. When they IPO'd back in August, they were on the list as one of the most popular traded stocks with Robinhood users on the Robinhood app. The initial stock price was around $18 and surged up to around $34 a share. Of course, it is typical for stocks to see a surge after the IPO and then level back off to more of a reasonable trading price after a couple weeks or a couple days of that initial IPO. Right now, it's hovering around $21 a share in the past couple weeks with really no major swings either way, which is a really good sign. It did take a slight dip back in Labor Day, but in general, the market kind of took a dip and leveled off some back then. The stock price right now, through several analysts, have kind of agreed that $25 a share is a reasonable target price of the stock, with a high of around $35 a share. So why now are they being labeled as a strong buy? Well, a couple days ago, they released their third quarter earnings reports, and it provided some very good news for investors or potential investors that are looking to buy into the stock. But before we go ahead and talk about that good news, give the channel some good news and go ahead and smash that like button. So talking about good news, the biggest thing that we like to see is how much revenue or how much growth they had from quarter three. Well, in quarter three alone, they generated over $4.6 billion in revenue and had over $3 billion in net income, showing some crazy growth since that quarter two or since that quarter three from 2019. Since Dan Gilbert bought the business back in 2002, they have slowly been chipping away at other competitors and have really emerged as one of the leading mortgage providers in the United States. Now, if the name Dan Gilbert does sound familiar to you, or if you don't know anything about Dan Gilbert, he is also the owner of the Cleveland Cavaliers, which became famous when they had superstar LeBron James playing and winning multiple championships. So back in 2002, when Dan Gilbert bought this business, they was producing around 7 million loan originations per year. And since that time frame, they have increased and come up to 145 million loan originations in 2019. Of course, 2020, at the end of 2020, we're probably going to see this number go even higher, because just the home sales in general and the refinancing and the new home purchases or new home being built is just going to increase this number for companies like Rocket Mortgage. So looking ahead to 2021 and beyond, Rocket Mortgage provides me two different strategies as an investor. One, I think they're a great short-term play because I think as we go into quarter four, they're going to blow past these numbers even more, which is going to send that stock rising a little bit. For me as well, as a long-term play, I think they have the business model and I think they have the projections to continue merging themselves as being the number one mortgage provider in the United States, which makes them a great strategy or a great option as a long-term play or a long-term option for you as your investments. Rocket has been crushing its competitors as far as profit margins. Back in 2019, Wells Fargo was the third largest mortgage provider in the United States. But since that time frame, and we see the earnings reports come out, Wells Fargo and these other main staple banks or financial institutions cannot compete with Rocket. Between Quicken Loans and Rocket Mortgage, they're crushing the competitors as far as their profit margins. Rocket has been crushing its financial competitors. Back in 2019, Wells Fargo was listed as the third largest mortgage provider in the United States for consumers. But since then, it's obvious, and with Wells Fargo's reports and Rocket's reports, they are crushing them as far as the profit margins they're bringing in. I think as we go into 2021, as 2020 closes, these numbers are going to just keep increasing because it is so easy for you to process a mortgage online instead of going inside of a bank such as Wells Fargo or these other leading banks such as Bank of America as well. In the short term, Rocket Mortgage is a very good play for investors because we see that historically low interest rates is continuing to entice people to either refinance their homes or purchase new homes. At the same time, the real estate market is still on fire. Even when everything that 2020 dealt us, the market did not take a dip as a lot of analysts were saying, and it's projected to continue the same moving into 2021. In the long term, this is also a great play. As I mentioned before, They're crushing these staple banks such as Bank of America and Wells Fargo as providing mortgages to consumers. Attach that to the technology that they use and the availability to process a loan, which we'll talk about in just a minute. They are in a great position to emerge as the #1 mortgage provider, if not as well as the auto provider in the United States moving past 2021. So one thing that sets Rocket Mortgage or Rocket companies apart from companies like we just talked about, Wells Fargo, is the ability to do everything online 24/7, have access to a financial advisor 24/7. Through the Rocket Mortgage app, the company offers closes on mortgages as few as 16 days for a home purchase and 8 days for refinancing, an achievement they marked in 2018, which if you look at the numbers, they probably got that a little lower since it's now closing out 2020. So one of the things I think has really helped Rocket really emerge as the leading provider for mortgage loans and mortgage processes is 2020. We all know that virus pretty much shut everything down. And a lot of banks, including Wells Fargo and Bank of America, closed their lobbies to consumers, whether it's a new customer or a reoccurring customer, and it really hampered their ability to provide a good customer service to process these loans. Bring in Rocket Mortgage or Rocket companies, and they say, hey, we can do everything online with 24/7. You can do your app, you can do it over your phone, you can do it on a computer. We're here, let's make it happen. And that's where they was able to really bring in all these customers and emerge themselves and produce the Q3 earnings reports that we just talked about. So bringing in new customers is a great thing, but keeping those customers and providing a good customer service where you get those referrals. And Rocket has been right on par with that. They announced that their customer service satisfaction rate was at a 92%, and their returning customer satisfaction rate or recapture for people bringing back business to them was at an 82% rate. To me, this says that customers are satisfied with the service. They're either satisfied with the customer service, they're satisfied with the low rates that Rocket can provide, they're satisfied with the easiness or the just the efficiency of processing these loans, and they're satisfied with the applications or the technology that Rocket has provided just to kind of incorporate all three of those things and providing just a really good overall customer service satisfaction rate. As with any company, there are concerns and there are risks associated with them. Rocket Companies has one of the biggest risks associated with them, and that is the housing market. Right now, everything is fine. The real estate market is on fire. Mortgage rates are low, and it's just increasing people to either purchase a new home for the first time or refinance their current mortgage. However, if the mortgage industry takes a hit, or if home sales decline, or if mortgage defaults increase faster than expected, this stock will be affected, no doubt about it. So keep that in mind as you're thinking about investing in this stock or just any stock in general, what the risks are associated with. Obviously, I'm not the person to go to for all your advice. If you have any more advice, I suggest you do your own research or talk to a certified financial advisor on what strategy or what stock is good for your investment goals. But for me, I think the stock can definitely increase 10-20% over the next couple months. Again, that target price or that high target price was around $35 a share. Right now, trending around $21 a share is a great short-term growth. But I think in the long term, with them emerging as one of the nation's leading mortgage providers and the technology that they're able to process that with, I think it puts them in position to be a great long-term play. That's it for me today, guys. Let me know in the comment section what you think about the video and or the stock. And as always, if you haven't done so already, hit that like button and or subscribe button, and we'll see you on the next video.